Hello folks, this is Nate Paulson from Paulson Wealth Management with an educational economic update for September 2016. In this month's video, we'll discuss some of the major headlines that influence markets in August and give you some insight into how they could affect you as an investor. Please stay tuned at the end for a required disclosure statement. Markets rallied for much of August on better than expected earnings reports and some strong economic data. However, official statements showing that the Federal Reserve is moving closer to raising interest rates again gave some investors pause. With the bulk of earnings season behind us, we have a pretty good picture of how U.S. companies performed during the second quarter. Looking at results from 483 S&P 500 members, we see that earnings are down 3.2% on revenues that are up by 0.1%. While lower profits aren't good, corporate managers did a fairly good job of managing expectations. Over 72% of those companies beat their earnings estimates, and just over half beat their expected revenues. The stock market treated most of this news as a win since traders had been surprised by the results. Surprises to the upside are always helpful. The Federal Reserve was also the source of a lot of market activity last month. Minutes from the July meeting of the Open Market Committee showed that Fed economists are split in their opinions about the economy and where interest rates are. The Fed hawks, those who want to raise rates soon, believe that the economy is strong enough to withstand higher rates as soon as September. This has created some market volatility. The Fed doves, which are economists who favor a more cautious approach, aren't convinced that a rate hike needs to happen quickly, and they think that low inflation and global concerns mean the Fed can keep going with their wait-and-see approach. We and most of Wall Street analysts don't believe that the Fed will raise rates at the September meeting. However, there's a reasonable chance they might act in December. That's what the yield curve futures markets are telling us. If the labor market continues to improve and economic growth looks solid, we could definitely see some higher rates before 2017. So speaking of economic growth, we got our second look at gross domestic product at the end of August. The first estimate, which showed growth of 1.2%, edged down to 1.1% in the second report. Why? Well, broadly, while consumer spending ramped up last quarter, business spending pulled back, leaving economic growth stuck in a neutral position. What that means is consumer spending, which is the largest factor in U.S. economic growth, kept the economy growing. Businesses took a look at their shrinking profits and closed up their wallets. This was the fifth quarter in a row of lower corporate earnings. So what can investors expect in the coming weeks? It's likely that we'll see more volatility and perhaps even a pullback as investors digest data ahead of the November election. The Federal Reserve votes on interest rates this month, and that will also add to speculation. As always, we'll keep you informed with everything as it comes available to us. That's it for this month's economic educational update. Once again, this is Nate Paulson with Paulson Wealth Management, signing off for the month. Please remember that nothing we mention here or talk about here is a recommendation. If you'd like to speak to us about your own personal financial situation, that's great. Please give us a call at 630-517-2950 and we'd be happy to speak with you. Thanks, and Nate Paulson signing off.